It's not something you forget. Not knowing when it'll be safe again to go outside, to buy bread or board a bus. Places of business and worship and community locked up. Borders locked down defensively. Livelihoods suspended indefinitely. Human beings labeled essential or not. Grown men and women too afraid to breathe easy, tying masks on children too young to tie their shoelaces. On the front lines, not enough beds, doctors said. Behind closed doors, not enough food, parents said.
Did you know that when you invest with PPS Investments, you can get so much more? Here's why. Number 1. Investing with family makes good sense. Our family network offering means that the more you and your family invest together, the more everyone could save in administration fees. Number 2. Investing with family makes great sense. If you are a profit share earning PPS member and you link your family's investments to your profile, you can increase your profit share. And number 3, the more products you hold with the PPS group, the more profit share you could get. Simply maximize your profit allocation by activating the Profit Share Cross Holdings Booster. So why not invest with PPS Investments? Not only will you get a partner with a great track record, but you'll also take your PPS membership to even greater heights. PPS Investments is an authorized FSP.
It's not something you forget. Not knowing when it'll be safe again to go outside, to buy bread or board a bus. Places of business and worship and community locked up. Borders locked down defensively. Livelihoods suspended indefinitely. Human beings labeled essential or not. Grown men and women too afraid to breathe easy, tying masks on children too young to tie their shoelaces. On the front lines, not enough beds, doctors said. Behind closed doors, not enough food, parents said. And always the fear, a suffocating hand pressed over your mouth. He'll be fine, he's a fighter, they said. And then, as so many weren't, he wasn't. In the ground, too many fallen soldiers. In the news, the dead reported like sports scores. And all the while, the soft, maddening tick of the clock, while households huddle in living rooms waiting for the next wave to hit, for a president to take to the airwaves. It's not something you forget when you've lived through it. An enemy invasion, a world in crisis.
Please welcome your host, popular media personality, actor, investigative journalist, and host of The Breakfast Show on 702, Bongani Bingwa.
Well, good afternoon, everyone. I could explain that photograph. Firstly, thank you for joining us today at the second annual PPS Retirement Summit. Yes, indeed, my name is Bongani Bingwa. So at the height of the more intense lockdowns, I decided to do something that I thought could be fun, and I did that to my head. And then, very unexpectedly, I think about 3 days later, I was called in for a photo shoot. And if I had done anything, the only option was to go completely bald. And you've already seen the size of my head, so that wasn't an option. So this is how I ended up looking like that, something I will regret for the rest of my days. But nonetheless, no longer blonde, I can happily say. I'm happy to be your host today as we discuss how to plan for retirement with purpose and really the retirement we all deserve. The need to be financially organized for retirement is becoming more and more prevalent amongst hardworking professionals. And the current retirement landscape is changing dramatically as population aging becomes increasingly visible, right? If there's anything the pandemic has taught us is don't change your hair too quickly. That's a joke. It is that there are fundamental misconceptions that many of us have about our future selves. Retirement is a lifestyle. It's not an event that happens when you are 60 years or a little bit older. But before we kick off, I'd like to ask all of us here a question to kind of gauge the room and where we are. Planning for retirement should not be a stressful exercise, right? It incorporates mapping out what you want, what we all want for the future. So here's a poll question. How do you feel about your retirement plan? A, I haven't considered it. B, stressed out. C, somewhat comfortable. And D, very comfortable, I'm on track. Which of those options best describes how you feel about your retirement plan? Now, as the results come in from the poll, I'd like to welcome Ayanda Siboni to the stage. Ayanda, of course, has been the PPS Group Executive for Marketing and Stakeholder Relations since 2017. She has more than 20 years' experience in the insurance sector and has worked in product and distribution environments, which complements a current role in classical marketing. Ayanda, welcome to the stage, and thank you for joining us today.
Thank you, Bongani, and thank you for being our moderator today. I'm excited to be here.
All right, well, Ayanda, the poll results are in, and our audience basically feels, let's see it all coming in there. So the options are, I haven't considered it, I'm stressed out, I'm somewhat comfortable, or I'm very comfortable and I'm on track. All right, let's wait to see what the poll results are there. Here we go, it's loading out. Well, I suppose before we do that, while we wait for the poll results before they come in, what's your sense generally, having been in rooms like this and what people typically say?
So people typically, it depends how old they are, right? When they're young, it's not really a concern. So they're like, oh, no, I'm on track. But the older we get, I think the more the panic sets in when the reality sets in. So I would expect from a results perspective that a lot of people will have different results depending on where they are. But it doesn't matter where you find yourself. Whether you find yourself a bit stressed out or you think you're comfortable, there is a solution for everyone. You might have to sacrifice a little bit more, but there is a solution for everyone.
And the important thing is to never relax, right? Never be too intimidated and find it too daunting and then not do anything about it.
Yes. No, for
All right.
sure.
Here we go. All right, I tell you what, the results haven't quite yet come in, but maybe we'll come back to them in a moment. But I suppose a good place to start our conversation is to ask you to tell us a little bit more about PPS.
So PPS stands for the Professional Provident Society. We're a diversified financial services provider offering a wide range of products, solutions, such as life and short-term insurance, investments, healthcare administration, fiduciary services, wealth advisory, among other services. So we're supported by our network of established intermediaries, both internal and independent, who look after the needs of graduate professionals from cradle to grave. So our main thing is that we operate under the ethos of mutuality, which means we don't have customers, we have members. Our mutual model is what makes us unique. Bongani, in the last 10 years, this might surprise you, but we have allocated a whopping 31 billion rand to members, and that excludes the money that we've paid out for claims.
You were saying earlier that it's never too late, right? So tell me what PPS does to assist its members, not its customers, with retirement.
So PPS is unique in the market in that it offers profit share, and profit share is a unique benefit that you get by just being a PPS member. So how the profit share works is that you accumulate value in your profit share through annual allocations to that PPS members get because they hold a qualifying product. The profit share funds are then managed by our specialist investment company, PPS Investments. It's a business with a 15-year track record, and it manages around 60 billion rands in assets. So we offer our members exceptional investment skills, both pre and post-retirement. We also offer our members great planning and advice with our 80-year track record. So the question for me is not so much how does PPS help members with retirement, but rather how does PPS and the intermediary partner with the member to give them the retirement they deserve? So this we do by, number one, we grow that profit share. It's a great asset that augments retirement savings. And we have quite a lot of profit share millionaires, so if you ask them, they will definitely agree. And we also have strong investment expertise, and working with your chosen advisor, we help you to live the life you deserve to live. Remember, retirement is an outcome, and you control the input.
You and I were, of course, together here last year, and if I reflect back on that conversation, were there any nuggets that stand out for you?
So Bongani, we're just so lucky that we live in the digital age where anyone who missed last year's summit can actually just go onto the PPS YouTube page and watch everything. So last year we launched the Retirement Summit, and the theme was Make Retirement Work for You. The topics that stood out for me were the 10 habits of financial freedom, where we discussed the key risks of retirement, like longevity risk, which is basically outliving your money, as well as one that we're feeling very acutely at the moment, which is inflation. But what encourages me about the now generation of members who are retiring is that they are redefining retirement, and they are retiring from their traditional professions to go into places where they are working for their purpose and passion. So we at PPS are keen, by the way, on inviting our members to partner with us to do things like mentorship of young people through our Professionals Connect platform. So experienced members can come and they can help younger members, and this will help reduce youth unemployment. We also discussed the importance of looking after ourselves, and this was by cultivating the right habits like eating healthily, sleeping well, and keeping ourselves moving. And speaking of which, I'm going to take this gap just to tell our members that in August, we're launching another Healthy Way Challenge. So we're going to ask people just to check our social pages when we launch that in August. And then last year, my favorite, I learned a new term, which was KIPPERS, standing for Kids in Parents' Pockets Eroding Retirement Savings. And that's a reality in our country with the level of youth unemployment that we have.
Right, a mixed bag. It was very insightful. Anil, who would be with us today, but unfortunately Anil could no longer attend. And so we are happy in his stead to introduce Taj Mohammed Badruddin. Thank you very much. Tauj is the investment positioning specialist at PPS Investments. Tauj joined PPS Investments as an investment positioning specialist in February 2022 after 10 years with Old Mutual unit trusts and multi-managers. With over 15 years of experience in the financial services industry, he strongly focuses on administration, reporting, and performance analysis. Over to you.
Thanks for the introduction, Bongani, and a good afternoon to everyone. Retirement is a key stage of life that we all go through. Indicative that we're entering later life, it's a time to sit back and relax, enjoying family, friends, and the rewards of working life. There's a reason why retirement is often referred to as the golden years. For many, retirement is viewed as a welcome reward following a long, hard career. Now, the reality and the transition, however, is not always an easy one. Planning for retirement can be a daunting experience, whether done early on in your career or even more so later on. It is therefore imperative that we find an appropriate investment partner to guide us through this, from laying the initial foundation phases all the way through to the culmination. It remains one of the most important components to any effective retirement plan. Now, importantly, the term investment strategy refers to a set of principles that are designed to aid investors to achieve their financial goals and their success. And your strategy largely depends on your personal circumstances, your age, your capital, and risk tolerance, as well as your goals. Now, they are by no means a static process, with re-evaluations with your trusted partners remaining a very key component. Today, we will look at just 3 of those points, or 3 strategies around wealth creation, preservation, and how best to manage that journey. The first component is what we like to refer to as knowing your toolbox, and really it's centered around the idea of asset allocation, and more specifically, strategic asset allocation. As a starting point, let's first address people's current concerns and their fears when it comes to equities, and in particular, South African equities. Now, looking at current news headlines, one would be forgiven for thinking that South Africa is a less desirable investment destination. However, long-term returns indicate otherwise. As we can see, over the last 120 years, South Africa is the 3rd best performing market in the world in US dollar terms, and has managed to give a real return of around 6.4%. And as such, that universe of return possibilities is pegged around that 6 to 8% real return mark. Now, this is an important starting point, as it will inform manageable and realistic expectations of what the markets can achieve and deliver. Now, the following chart shows the rolling. Similarly, over a 5-year rolling return period, the JSE All Share has managed to return positive real returns 86% of that time. Now, what this shows us is that investing is really all about perspective. And despite equities appearing less attractive during volatile markets, it still managed to have provided strong inflation-beating returns over the long term. So now that we've looked at equities, let's have a look at how lower risk asset classes compare. At the moment, people are scared, and when people are scared, they tend to rush out of riskier asset classes like equities and place their cash in cash or bonds. And by overlaying a cash and bond profile over the JSE All Share Index, what we can see is that they rarely outperform equities over a 10-year rolling period. Be compensated with higher returns for taking additional risk, or will expect to receive a lower return for being more risk averse. Now, over the last 100 years, there's been large differences between the returns of various asset classes. And in general, equities have returned much more than bonds. but at a much higher volatility, which is a measure of risk. Now, for most investors, it is that return above inflation that really matters. At the end of the day, what we're trying to do is we're trying to keep pace with inflation, but still manage to deliver real returns on top of that. As we can see, since 1920, South African equities have managed to return 8.4% annually above inflation. And looking at it like this, one would be forgiven for thinking, why would I invest in anything but equities? Well, the answer is that investors have varying investment timeframes and goals. And while the long-term returns are important, so is the volatility under which those returns are generated. Now, if we were to drill into the real returns per decade and sort them from best performing at the top to the worst performing at the bottom, what we understand and what we can see is that no one asset class reigns supreme all of the time. Asset classes can move from top to bottom under different market conditions and different market cycles. So, by way of example, if we look at global equities during the 1950s period compared to the 1970s, what we see is that it was the top performer in the 1950s with a return around 15%. However, in the 1970s, which was marked by high inflation, eroding the value of investments in real terms, and here global equities had an annualized real return of minus 1.74%. So it's quite clear that not every period equities are going to outperform, but what actually is needed is a mix of assets. Understanding this and bringing it back to the importance of investing in the correct asset allocation. As we've seen, different asset classes give us a different mix of return and volatility. And our ability to blend these asset classes allow us to manage the overall risk and return of the portfolio. An example of this would be the PPS Inflation Plus 5 strategic asset allocation, which really is the ideal mix of asset classes to target inflation plus 5 over the long term. From the chart, what we can see is that the strategic asset allocation manages to keep pace with the JSE All Share Index, but at a much lower volatility. And while the returns are similar, the difference in risk is significant, some 11% versus that of 20%. And as we've done before, by zooming into the data to gain greater insights and inform our future behavior and decisions. Whether it was in bull markets or bear markets, the data clearly illustrates that the benefit of the multi-asset class portfolio lies in its ability to effectively limit the downside risk, lower volatility, while still capturing strong market performance. So, for example, in the 1978 to the 80 bull market, we see that the all-share returned 44%, while the SAA returned 30%, but at a much lower volatility. And in contrast, a similar period bear market, the SAA returned minus 8% versus the all-share, which was down some 25%. And as we go through the period, you see a similar pattern appearing. Now, you're never going to get the highs of the market by being in a multi-asset class portfolio. But because of the downside protection being so strong, it does allow you to still keep pace with a full equity portfolio. A well-diversified, multi-asset class balanced portfolio therefore presents such a strong case for effective retirement solutions. Not only is it Regulation 28 compliant, but it has that ideal mix of both local and offshore, as well as cash and bonds. The next strategy that we're going to employ is around trusting the professionals. Now, investment managers bring to the table a host of skills, expertise, and knowledge to best deliver upon client goals and expectations. One common mistake made by investors is selecting managers based on their past performance. And very few managers are able to consistently deliver great performance, and for various reasons. This means that spreading your money across multiple managers, it allows you to diversify that idiosyncratic risk, minimizing the possibility that poor performance will negatively affect your overall portfolio performance. And this really brings us to the importance of multi-management and what that has to offer. By making use of a multi-manager, one can gain access to expert knowledge and research capability to choose the most appropriate set of funds and managers to complete a portfolio. It is really designed to take that worry out of where to invest through a comprehensive and a thorough process. By way of illustration of this, what we show is the PPS Balance Fund versus 7 of the biggest retail balance funds in the industry. And here we see that the fund has managed to achieve excellent fund returns relative to its peers, and once again, at one of the lowest volatilities. Now this brings us to talk more about portfolio construction and what it is. And quite simply, it's that engineering behind how we meet our client needs. It's a process that is rigorous, comprehensive, and consistent to ensure that results are delivered time after time. And the first step in that process revolves around screening, which is basically a process of searching for managers that possess an element of consistency. They're not just the top performing manager this quarter and then suddenly they drop off next quarter. Step 2 is really around manager selection, both quantitatively and qualitatively. Are they applying and sticking to their philosophy? And are they adding value consistently? Once we've gone through that process, the next step is how do we blend those managers together, different visions, different sets of skills, in a way that really optimizes the portfolio as a whole from both a risk and a return perspective. Step 4, globally anymore, and not within a South African context, but rather towards the South. And the concept of behavioral finance, which is really the study of the psychological influences on individual investors and their financial markets as a whole. Understanding how we as investors behave, react, and view different market events plays a significant role in how we navigate that investment journey. Irrational, impulsive decisions are often influenced by both internal and external factors. Concepts such as bounded rationality or lack of self-interest all play an important role. Now, we're not going to have all the information all the time, so what we do is we take mental shortcuts in order to get there. We also have limited capacity to process an infinite amount of information, and this can often lead to confirmation biases or decisions being made upon greed or overconfidence. The next illustration is that of the cycle of investor emotions, and it's important because the journey that one has to navigate as a long-term investor through the different cycles and understanding how we behave and why we behave in a certain way allows us to recognize potential risks and opportunities. The reality is when things are great, we feel that nothing can stop us. And when things go bad, we need to take drastic action. And because emotions can be such a threat to investors' financial health, it's important to know how to keep your head above water in the cycle of investor emotions. This emotional cycle often leads an investor to make the wrong decision at the wrong time. We've all heard the saying, buy low and sell high. Well, logically, that means that you need to be selling when everyone else is buying and buying when everyone else is selling. The reality is that it's much easier said than done. People, on the other hand, tend to be a lot more emotional about their own money than fund managers. And fund managers have the ability to objectively view these events and often have many historical events to use as a reference point for unexpected events. At the end of the day, it's the investor's behavior that has a significant impact on their outcome, especially in difficult times when we navigate both FOMO and FOLO, the fear of missing out and the fear of losing out. We need to mitigate and kind of downscale that market noise in order to overcome it. So just by way of a simple illustration, we've got the S&P 500 under two different scenarios. And the reality is if you missed out the top 10 days over a 20-year period, you would have underperformed significantly. The market's best days typically follow the largest drops, meaning that panic selling can lead to missed opportunities on the upside. It's quite evident that trying to time the market is a fool's game. Rather, investors should stick to their financial plan, trust their investment partner, and believe in the process. In summary, what we spoke about is really 3 key components. 1, knowing your toolbox. 2, trusting the professionals. And lastly, and most importantly, is around minding your own behavior in managing your investment journey. Thank you very much.
Thank you, Taj. Maybe you can join me on the couch and we can look at 1 or 2 considerations from what you were presenting there. I was really curious because I'm one of those people, perhaps, who informs the negative headlines.
Yeah.
And I was really, really surprised to see what you were saying, that over a long period of time, what's in the headlines does not necessarily reflect what we do and how we perform as an investment decision.
Absolutely.
As an investment destination, I should rather say. And Ayanda spoke about emotions, right? So often we make our decisions based on what we are feeling at a particular time, which is really actually a snapshot of what unfolds over a period. So how do you keep your emotions out of it?
Yeah, I think, Bongani, it's a very important question, especially in today's climate with high volatility and rapid market changes. You know, the fluctuation between excitement and panic is usually that ends up hurting investors the most. So my first point is really just acknowledge your emotions. Acknowledge the fact that your fear and your anxiety are normal responses to unexpected events or news. I'd even go as far as saying, Bongani, if you want to panic, panic. Just don't panic about panicking, you know? And most certainly, don't act on your impulses. Take a moment to just pause, reflect, and reassess the situation. Ask yourself, you know, has something fundamentally changed in my investment goals or my objectives? If they haven't, right, then the recommendation is to stay the course. If you feel that they have, here I want to put forward the importance that your financial advisor really brings to offer. It cannot be stressed enough how important they are to aid you in navigating that investment journey through both the highs and the lows, Bongani.
It's a little easier said than done in some ways, because if you look at the rand now and the battering it has been taking, and you look at the weak local macro environment, one of the temptations will be for people to think, let me just take everything offshore.
Yeah, well, it really does depend. It depends on your investment plan, Bongani. Right? Offshore investing is a sensible move. I think it's an important aspect of diversification, and it really gives you access to different sectors, geographies, companies that you wouldn't normally be able to access here in South Africa. But at the same time, I think it's also important to recognize that there are a number of companies listed on the JSE that actually derive their revenue in foreign currency. So why is that important? Well, pleasure. Thank you very much.
Thank you very much. I mean, ultimately, I suppose the thing to think about is that there are various considerations, options, directions we could take in planning for our retirement. Now, the following presentation looks at what to think about when setting up your retirement strategy, not only the income you will require, but also the lifestyle you want to live. I'm going to invite Linda Sherlock to come. Linda, of course, is the executive head of PPS's Wealth Advisory. Linda started in PPS Advisory Services in March 2019 as the executive head of Wealth and Business Development. Prior to that, she spent 22 years with Alexander Forbes, fulfilling various roles from regional head of consulting, national head of retail consulting, head of the advisory business, and then managing executive of business and distribution enablement. She is intrinsically involved in the strategic direction, understanding, and implementation of what drives a consulting business for both clients and financial planners or wealth managers, ensuring, of course, that the future is ready in terms of the world of financial planning. And as she comes up, let me also apologize to our virtual audience. We are having some connection problems. We are aware of them, and of course, we are working to resolve them. Over to you.
Good afternoon, everybody, and Bongani, thank you for that warm welcome. If I'd just like to let our online viewers know that if they still experience technical difficulties, if you can switch to YouTube and you can search the summit on YouTube and you'll have no technical problems there. Our apologies again. So the section that I'm going to be talking about today is about building capital and preparing for your retirement lifestyle. For many, a very daunting, however, doesn't need to be experience. If we can equip you, give you the knowledge, it's a highly manageable time of your life, but very personal, so everybody is different. Retirement capital is inclusive of your savings funds, your retirement annuity funds, your pension and provident funds, but it also things like properties that you may have bought. It could also be a business that you've built up over years. And it could be those rental incomes that you receive from the properties that you've bought. So the takeout from building capital is, please keep in mind that not all of your capital pots are equal. That there are tax differences, there are liquidity differences, and different withdrawal patterns that you'll need to make within them. So not all retirement capital is equal. Moving on to some of the retirement trends that we're seeing in South Africa at the moment. 5.4% of South Africans are over the age of 65, which is lower than the international trend at 9.15%. The life expectancy for middle-class South Africans, for men is 79, and for women 83. And there is that industry average of 6 people out of 100 can retire on 75% of their final salary. However, I'd like to focus today on the sandwich generation. Bless you. The sandwich generation are those people who are planning for retirement or are at retirement, but still taking care of both kids and parents. In our world of data, our African map will show you just how big a problem this has become. And it's not an Africa-only problem. It's an international problem. In South Africa, if we look at our own stats, we can see that while we've progressed, and it has got better over the years, effectively for every 100 people earning an income, there are 50 people dependent on those people. So we have this bigger and bigger problem, and of course, Ayanda spoke to it earlier, in terms of employment rates, it's becoming an even bigger problem. So what is our takeout? Traditional retirement planning has to take into account the young and the aged dependents that are dependent on us. And this affects you in both your build-up phase and in your drawdown phase. So it's an important takeout. Additional trends that we are seeing is that people are staggering their retirement. The shift is definitely away from formal retirement to staying economically active based on your terms, what you want to do, what your passion is. And the traditional work age arc, as we know it, has changed significantly. Multi-generational living, parents in a granny cottage at the kids' house, or kids moving back into home. Our millennials are getting married later, so they're staying at home longer. We have the rise of the longevity economy. This is an economy that's supporting goods and services for the amount of people who are now actually in retirement. And in fact, in America, it's become a real player in terms of the GDP of that country. Of course, some of the trends are we have now 3 distinct retirement phases. We have an active early phase, a mid-moderate phase, and then a late slowdown phase. But each of these has a different spending pattern. In the early phase, we spend more. In the mid phase, we reduce. But of course, at the end phase or last phase, suddenly our expenses go up again due to healthcare and medical aid. Inflation has very little impact on when people retire. So if you're worried that in an inflationary market like we're in now, we'll see less or more people retiring, statistically it's been proven that inflation is not a trend. We also find in South Africa that empty nesters are taking flight in retirement. They're either downsizing or semigrating. The biggest receiver of semigration, of course, is the Western Cape. What do you need to keep in mind while you're going through or considering semigration? Certainly there's a cost involved. Please keep in mind that frequently selling your house and buying one in a different province may not be as cheap as you think it's going to be. Registration costs, moving costs, transfer duties are all costs that you need to take into account if you're on the semigration bandwagon. However, the biggest cost that I want to bring to everybody's attention, and the one people don't necessarily plan sufficiently for, is healthcare, particularly medical aid. Medical aid costs have increased annually above inflation. And that is something that you really need to take into account when you look at your long-term income drawdowns and what you need for your medical aid. I'd also like to chat and share about a couple of rules of thumb that I believe that you can, in your own home or office, sit down and do a bit of planning for yourselves. Our first rule of thumb is the capital rule of thumb. Basically, for every 5,000 Rand that you need in income, you need 1 million Rand in capital. Or you could look at it, I need between 10 and 15 times my final income to meet my last salary. So either look at the 5,000 per million or look at 10 to 15 in capital for your income generation. Our income rules of thumb. 4%, the 4% rule states that you can draw that off your capital to ensure that your capital lasts as long as you may live. So it's a longevity protection rule of thumb. The capital does need to be invested, as Taj said, in the right market, with the right asset allocations, in a multi-managed portfolio to give you the inflation protection, drawdown protection, and longevity risk protection that you'll need. Our third rule of thumb is the expenses rule of thumb. Take your current expenses, take out the items you no longer will be paying, for example, contributions to a retirement fund if you're in an employer fund, but add in all of the new expenses that are going to come. You're going to travel. You might want to buy a car. You might move into a different security village with higher monthly rates. So you need to do that calculation. So what is the takeout on these rules of thumbs? Do your calculation, see how much capital you have available, look at what your income needs, and it all starts with a budget. We also have a rule of thumb on retirement savings. So how much do I need to save to meet my capital need? The rule of thumb is if you start at 25, at 15%, you're good. You're going to have a great retirement. However, life doesn't happen for most of us on that basis. It's not a straight line. So if you're 30 and you start saving, you need to be putting away 22%. From 40, 42%, and up to 59% if you're only starting at age 45. But before we go into that, I just want to talk to you about heuristics. So heuristics is a behavioral finance, or it's actually a psychology finance item. And how does it play out in the retirement and planning space? It's that we make decisions like that. So we look at a few things and we're like, cool, I'm going to do that. That is detrimental in retirement planning. In retirement planning, you need to look at the detail. You need to research, you need to understand. So heuristics work against us. So now that you're aware of heuristics, what do we need to understand about behavioral finance? The very first one that you need to be aware of is hyperbolic discounting. Hyperbolic discounting is when you are prepared to give up the long term for some instant gratification. So I think people will remember the marshmallow ad with the children. That was a hyperbolic discounting example. So we'd rather have something now than defer it for the future. It can also work in your retiring years where you may draw down off your capital too early, therefore reducing your longevity or increasing your longevity risk. The second one from after hyperbolic discounting is herd mentality. This is when we go to the braai or we at a dinner and everybody's talking about gold. Gold's the thing. I mean, in our lives now it's crypto. Crypto is the thing. Or they explain to you how they've managed to unwind from a particular equity and get into something else. And they've only got good stories to tell about it. Get your portfolio to be in the asset classes needed for the outcomes you're looking for, planning phase or post-retirement phase. So what is the takeout on this one? Be aware of your biases. Your wealth manager or financial planner is the neutral, skilled party to ensure that those biases are removed. They're the person that can remove the emotion, Ayanda. So what does this mean for me? How much do I need? Let's bucket this question into two key areas. How much do I want as a lump sum, and why do I want it? So our tax table, which is being reflected at the moment, South African tax table, says to you that up to 500,000 Rand is tax-free. And anything over that, then there's certain tax rates applied. However, please keep in mind that if you've done a severance package, that's already been taken out from your 500,000. Why is this important? In taking a lump sum, you can actually take up to 1/3. The question is, why am I doing that? So that 500,000, let's hypothesize that you only take that amount, should be reinvested to assist your income generation in your retirement years. Therefore, just because you can take 1/3 doesn't mean you should take 1/3. And once again, your wealth manager or financial planner will do those calculations for you. Our second bucket is on how much do I need in terms of an income. Well, unfortunately, that is very personal. But what we can remind you of is that the 4% drawdown rule. The minute you go over the 4% drawdown rule, you're eroding into your capital. So while you're looking at what income you need, the need to plan early and to actually understand what is my capital, what am I going to get, and what trade-offs do I need to make. And potentially some of those trade-offs need to happen in the build-up phase, but they also need to happen in the retirement phase. So the takeout here is post-retirement, managing the longevity, inflation, and consumption risks are the foundational items for retirement success. Okay, let's talk about our annuity income solutions. So we have a market that is mature. We have multiple solutions available to people at retirement. This is for the money that you've received from your retirement fund or from your retirement annuities or your preservation fund. And we have really two key areas. The one is a guaranteed annuity and the other one is a living annuity. Both of them have different aspects to them that may work for you or not. On the guaranteed annuity side, there's protection. And you're able to add additional items to it, such as inflation protection, or your spouse. However, the more things you add to it, the lower your starting pension. On the living annuity side, you have a lot of flexibility. You're able to leave it to your significant other, or you're able to leave it to a beneficiary outside of your estate. There's definitely a discussion about having a hybrid. So taking your living annuity and having a guaranteed solution embedded in the living annuity. And that is where I think people should be considering where they put their retirement assets. Understand the different decisions you need to make so that that decision is made over time and not as a heuristic decision. And post-retirement, manage for the long term. Annual check-ins with your wealth manager. What is happening on my investment? What are my drawdowns doing to my capital? How is inflation, potentially detracting? And I'd just like to leave you with this thought. When we go out and buy a brand new car, and in this example, I'm going to use a Toyota Land Cruiser 300 series. It's a lot of money. I think it's about 1.5 million at the moment. So we'll spend a lot of time Googling, researching about the car. We'll go into negotiations on the warranty. We'll open the doors and smell the leather. We'll fall in love with this car, but we'll look at what motor journalists have had to say about it, etc., etc. Lots of time before you go out and spend the 1.5 million. When it comes to your retirement, take that and multiply it by 20. That is the research and understanding you need to gain before you make a decision. It is not 30 days before retirement. It starts now, no matter what age you are, and it can be very beautiful. Thank you very much.
Thank you, Linda. Let's you and I have a little bit of a conversation. I think it was Taj who spoke about not putting all your eggs in one basket.
CISA, who create our standards for the industry, they suggest that you apply to a living annuity as an added protection. So Regulation 28 is there to assist us.
Is there a rule of thumb for the type of annuity selected at retirement by a member?
Thanks, Bongani. So unfortunately there isn't, but what there is understanding that the one is embedded in a guaranteed structure on the insurance company's balance sheet. Should you pass and not have built in a spouse as a partner, it will stop. But it does have the other side of an inflation protection, and it's, as I say, it's guaranteed.
Of course, is that at least all of our speakers are with us in the room. What we're going to do now is we're going to take a 10 minutes or so, a comfort break, just to stretch our legs. But I'm really, really excited to tell you that when we come back, we've got international speaker Richard Carlisle, who's going to be telling us about global investing. So let's take a 10-minute comfort break, and we'll be back here in 10 minutes. Thank you. All right, thank you very much. Welcome back, everyone. Have a seat as we begin. I hope you were all able to grab a cup of coffee, glass of water as we gear up for the next segment of the PPS Retirement Summit for 2022. Plan for the retirement you deserve. Now, a little earlier on, we started, of course, with that online poll. How do you feel about your retirement? I haven't considered it. Came in at 7.5%. Stressed out is 28.3%, and this is a really encouraging number. Somewhat comfortable, 50.9%, and very comfortable, I'm on track at 13.2%. So roughly all in all, about 64% of respondents on the right side of this planning. So I think that's really, really welcome news. Because, of course, against a backdrop of slowing growth, rising inflation, we've got that tragic war in Ukraine, it all adds a whole lot of risks, uncertainties, and unknowns. However, history has shown that markets tend to power through these dark periods where geopolitical issues kind of put shocks in the system, right? So our next presentation is really going to help us remember what's important, and I think the constant message, the constant refrain from all our speakers is to try and stick to our plan and think about things for the long term. I'm really pleased to tell you that our next speaker is Richard Carlisle, who's here, and the title of his presentation is his title rather is Equity Investment Director at the Capital Group. Richard.
Thank you for the introduction, Bongani. Thank you very much indeed. And also thank you very much to PPS for inviting us. And I'm here with my colleague Alexandra, who's sitting at the back, to present to you today. I should point out that the last time I was in South Africa doing a presentation was in February 2020. I went back to the UK, and a couple of weeks later, global lockdown ensued. So if there's a global crisis a couple of weeks' time, I know I won't be invited back. So fingers crossed for that. I'm asked to talk about three things today. One, briefly, is the capital group, just to give you an indication of where we come from. And I'll just move on the slides. Secondly, some words about the macro environment, which, as Bugani says, has lots of moving parts at the moment. And the third is to talk about the PPS Global Equity Fund, which we are privileged to manage. We've had a partnership with PPS going back to the summer of 2019, and at Capital, we value that partnership. We get on very well with PPS. We think they are well aligned with the way we run money, and we hope it continues for many years to come. So let me say a word about Capital, and the slide is up there already. So we are an employee-owned global asset manager. We have been investing since 1931, so just over 90 years old, and we've been corporately stable in that period. That comes from being employee-owned. We are lucky enough to have over 450 investment professionals, and on average they have 28 years experience, so they are not spring chickens. We are lucky enough, and we're entrusted with $2.6 trillion of assets, which makes us the world's largest active equity manager. But we are the first to say that that is $2.6 trillion of other people's money. It's not our money, and we are aware it can be taken away at any moment. So that's the most important thing we do, is making sure that money is properly managed. So that's a little slide on the Capital Group. So let's talk about the macro outlook on two slides. So, and I hope this won't surprise you. I think maybe I've been told by various people it's a little bit cautious, but this is, you don't often get stock markets falling 25% when the macroeconomic outlook is all positive. But let's look at why we think markets have had such a poor start to the year. The first, I think, is that growth is clearly slowing, and be it geopolitical risk or increasing uncertainty, growth is clearly slowing, and risk of recession is rising. We would say, in particular in Europe, which is closest to the Russian energy issue, and in particular Germany, recessions there really look quite likely. In China, the world's second largest economy, they too are struggling to cope with a property sector that seems perennially weak, and many of those property companies have very significant debts, so that's also a worry for us. Inflation has risen this year very sharply. The IMF now expects 9.5% inflation this year, which is going to be the highest for decades, and the risk of that dreadful word stagflation, so stagnant growth, no growth, and inflation has almost certainly increased. The policy dilemma for central banks is controlling that inflation without ruining economic growth, and that is an increasingly narrow path along which we think they walk. The stock markets are pricing in federal funds rates of 3.5% for the end of the year, and obviously last night we had a 0.75 point rise to 2.25% to 2.5%, and I think that is the background that's caused markets to be weak this year. Let's look at that in chart form. These charts were prepared 2 weeks ago, and they're already out of date because the IMF, these are IMF forecasts for economic growth in the world, in advanced economies and developing economies. And since we published them, the IMF has cut their forecasts for both 2022 and 2023 reasonably significantly. So we are in the midst of adjusting to declining growth rates, and I think that is well known. Let's look at inflation. Now, these charts, let's be clear what we're looking at here. We are looking at 10-year expected inflation rate. So it's not current inflation. This is what the market thinks inflation will be over the next 10 years for various economies. You can see South Africa is nicely at the top of the pile in terms of consistently high inflation. But look at the change you've had in various of those countries. If you look at Germany, which is a sort of funny green line, that has moved from 1.5% inflation expectations 2 years ago to 3% now. Doesn't sound much, but that really is a big move. Reassuringly, most of those lines, interestingly not the South African one, have actually rolled over recently. So there is an argument that we are actually past peak inflation fears. And I think that is a reassuring aspect of these charts. If we move on to look at interest rate expectations, here we go for various economies. The US, we expect, as we said, to see 3.5% interest rates at the end of this year and next. The UK, not far behind. But Europe is much weaker, having had the first interest rate rise in 10 years in Europe. The Germans are already calling for a cut. That illustrates how weak the European economies remain, unable to withstand higher interest rates. The other issue is that central banks are clearly behind the curve, is the phrase that everyone used. They've not raised interest rates sharply enough. This is the US, and back in 1992, an economist called John Taylor invented the Taylor rule as a rough and ready guide to what interest rates should be, and that is the green line. And you can see it's been a pretty good fit historically, but you can see how far behind the curve the US became at the start of this year. The Taylor rule says US interest rates should be 10%, maybe that's overdoing it a bit, but certainly at 2.5%, they've looked too low. So we have central banks misjudging the rise in inflation and looking behind the curve. That's not a great background for markets. So in summary so far, we'd say that there is a lot of uncertainty around at the moment. Forecasting is certainly difficult. You need to work out whether Russia is going to supply gas to the rest of Europe, and that's a difficult thing to forecast. But we do expect a good chance of recession. The US may be in recession now, but we worry more about continental Europe. The good news is, as far as a capital perspective, we don't invest in economies, we invest in companies. And we think we can find companies that will do well whatever the macro environment. We've done that for 90 years, and we are looking around for companies that can prosper in this environment. So let's move on and look a little bit at the PPS Global Equity Fund. So since I was last in South Africa, we've had a roller coaster time. We had a COVID bear market, and the grey line is the index we compare ourselves to, and the blue line is the performance of the PPS Global Equity Fund. We did provide a little bit of downside in that fall in the market. I think we would say we did particularly well in the growth rally, where companies that were going to prosper in lockdown, some of those Facebook, Amazon, Netflix, and Google group did particularly well. We kept that in the rally that came when the vaccine was discovered, and we kept that in the global economic rebound. To be fair, we have lost some of that outperformance this year, as there's been a rapid rotation from those growth stocks into more value stocks, and we'll come on to that in a second. But we are confident in our portfolio. We have moved away from growth companies, and I'll talk about that later, into value. But we have lost a little bit of that returns, but nicely ahead over that complete period. Looking at this value growth rotation, let me just sort of stop to say what that means. It's not a concept we particularly agree with, and one of our most senior investors points out this fund was launched before the concepts of growth and value were really invested, but we can understand it. So value companies tend to be slower growing, cheaper, paying dividends, and growth companies tend to be, as the name implies, rapidly growing, often don't pay a dividend, and this dreadful phrase, FANG, so Facebook, Alphabet, Amazon, Netflix, and Google, is a sort of good broad description of FANGs. This is a long-term chart going back to 1975, comparing value to growth. You can see in 2000, and I may be the oldest person in the room, so maybe the only one that remembers this, but that's when the TMT bubble burst. So you had a rapid run-up of technology companies, and in February of 2000, that bubble burst, and everything that had gone up went down a lot. Well, the move we've had this year has been of a similar scale. So we are really at a sort of the limits of a stock market rotation. This is not a small thing. This has been a major shift in market leadership, and it's been very quick in a 6-month period. Let's look at the reasons to stay optimistic. So let's look at 4 factors. First of all, inflation. Whilst we admit this is likely to be higher short term and probably more persistent, don't forget there are very significant deflationary factors at work. You know, technology is a very significant deflationary factor. You just have to think of what self-driving trucks in the US would take out of distribution costs to imagine that in the next 10 years, you know, you can have much lower distribution costs as an example. On interest rates, what we're really doing is moving from an extraordinarily low level of interest rates back to normal interest rates. I mean, 2-3% historically is arguably still low, and normalization has been a good thing. I think we have to accept history has been unusual. We've needed low interest rates to boost economies, but in a way, normalization is a good thing. Economic growth is going to be slow, but many economies, and we would highlight the US in particular, have bounced back from periods of weakness in the past. Many economies have proved very robust and bounced back well, be it financial crisis 2008, be it COVID, be it this rotation now. So we are optimistic that growth will bounce back. And, you know, in a way, if you're a bottom-up stock picker, having a very small number of companies like Facebook, Amazon, Netflix, and Google, the only ones that are going up, is a challenging environment. We actually look forward to an environment where markets broaden out, and stock markets are not just 1 or 2 companies doing well and the rest doing badly, but they are more earnings-driven and broaden out. So we look forward to that element. Just returning to this growth value concept for a second, this is the history of the PPS Global Equity Fund. I would divide it into 3 phases. The first, up to 2008, when our growth and our core and our value exposure were reasonably constant, no major changes. The phase from 2008 up to the 2018, 2019, where we did increase our growth exposure. That was correct, we think. That was the area of the market that did really tremendously well. But we have been reducing it since 2018, 2019. We've done it gradually, we've done it slowly. Arguably, we started too early, but we should have done it quicker in the last 6 months. But that's the way we run. Let's look at individual companies we've bought and sold in that period. So on the reduction side, some of you who've listened to me before will know that we love Tesla. Tesla is our largest holding. It's done phenomenally well, and it is the company who we have sold most shares in dollar terms. We've reduced that most, but it's still our largest holding. We've reduced Amazon. We've reduced Mercado Libre, which is a sort of Latin American version of Amazon. Some technology companies, MasterCard, Visa, etc. SoftBank, the big Japanese tech investor. Activision, who make the Call of Duty franchise, and Nintendo. They have been our sales. And our purchases have been much more industrial. So the biggest single one is actually Caterpillar, and we'll come and talk about that in a second. We bought a railway. We've bought Carrier Global, which is an air conditioning company, interesting against the background of global warming. We've also bought Sika, which is a Swiss company which we think has fascinating technology to recycle cement, something that no one else has. And we've bought Sherwin-Williams, which is a Cleveland-based industrial paint company with technology. So not really technology companies at all, and that has been the gradual shift since 2020. I think in an inflationary environment, you need to find companies that have got pricing power. So let's have a look at one of our top 10 holdings in terms of pricing power. We've picked LVMH, Louis Vuitton Moet Hennessy, which in our humble opinion is probably the world's greatest collection of luxury brands. I mean, you name a luxury brand, there's a fair chance they own it. They bought Tiffany a couple of years ago. Their profit margins are truly astonishing. You know, they've been 66%, gone up slightly to 68% in the last 10 years. So, you know, when you buy luxury, you are certainly paying for it. I am no expert, but apparently the Dior medium lady bag, which is a handbag, used to cost a mere $3,300 in 2013, now costs $5,200. That's a 60% price rise in 8 years, and yet there's still a huge waiting list for it. So if this isn't a company that knows how to raise prices, I don't know what is. So we like Louis Vuitton. Next, I'm going to talk about green energy. And I've learned this week that going around talking about electric vehicles in a country that is talking about load shedding is not the most sensible strategy, so I apologize for that. But I have to say that where I come from, in Europe, Tesla is actually the #1 best-selling car. I mean, the Tesla Model 3 was the best-selling car end of last year, going on in this year, and high fuel prices are sort of encouraging that trend. There's a whole myriad of ways we can benefit from the shift to green energy, and we illustrate them here. There is the rollout of chargers, there's energy storage, there's energy solutions, EV infrastructure, etc. But we've picked one, the machinery and construction side, which gives us an opportunity to talk about Caterpillar. So Caterpillar is, we think, a driver of this energy transition. It's covered at Capital by an analyst in New York called Gigi Parsadani. And as she says, it's not a laggard, it's a leader. There's a huge amount of spending needed to fill this infrastructure gap so that people can use electric cars. And we think Caterpillar is going to be a beneficiary of that. It's also going to benefit from self-driving technology. Those big yellow trucks will be able to be driven around mines by a person running 20 at the same time, sitting in a control room, maybe in another country. So that will help them transition from being a single seller of trucks to being a provider of a service. So that's an interesting new investment idea. I'm coming to the conclusion, but for us, New Perspective is a time-tested strategy. It's nearly celebrating its 50-year birthday. That will be next year. It's flexible. It's built bottom-up, company by company. We aim to have no systematic bias. It can freely reorientate itself to where we see the best opportunities. It's managed on a long-term basis. We've been owning Tesla for nearly 10 years now, and it's done well in both up and down markets. This is the chart showing its history. So far, we have never underperformed a 3-year down market. That's a track record we are proud of. And if I just flip to the next page, you can see that whenever you bought it in history, there's an 84% chance that 1 year later you are making money. On average, you've made 14.8%. And if you wait 3 years, you need to be very unlucky if you're not having a positive return. And we've never not delivered a positive return over 5 years and longer. So summary from me, it's a time-tested approach, it's a fascinating opportunity set, global equities, no structural investment style or factor bias, and a good history of downside protection. So I will pause there and talk to Bengani.
Indeed, let's have a seat.
Thank you.
You've just extolled the virtues of this New Perspective strategy, how it prides itself on being able to evolve with market trends and style. But how much has it been able to adapt, if you will, to the current shift from growth to value?
Well, I think, as I say, we started reducing growth and value 3 years ago. And if you sell, 2/3 of your Tesla holding in that period, but Tesla shares go up so much, you need to move quickly. I think, you can say that actually in the run-up to the peak of the markets we saw at the start of this year, I think our returns surprised even us. Some of our best years we've had in 50 years were in those run-up to this year. But we have to be honest, this year we have rather mistimed it. And I will openly admit we've made 1 or 2 analytical mistakes, and I would hold my hand up and say Netflix, we have been surprised by how quickly their subscriber growth tailed off, and in a highly rated company like Netflix that can be painful. But we still hold Netflix, and it's starting to recover, so optimism there.
I suppose Netflix is indicative of other things. If you look at the US, all the talk now is about a recession there. The Economist, in fact, are saying that 3/4 of Fortune 500 companies are bracing for negative growth by the end of 2023. Yeah. How do you see that playing out?
So the US may well be in recession. I mean, you only know when the final GDP numbers are published and revised. It may well be in recession now. I have to say, we don't expect the US recession to be at all severe. The US has always been a flexible economy, it's a creative economy, it's got flexible labor force, and it goes into this phase with full employment. I mean, there is a job shortage in the US. That's a pretty good position to go into a recession. As I say, I think we worry more about continental Europe, much more involved in the supply of Russian gas. And, we have economists that are saying, could Germany have a recession of 4, 5, 6% decline in GDP? Whereas I think the US, 1 or 2% is going to be the maximum you're going to see. So we worry less about the US, more continental Europe, to be honest.
Because, of course, we all thought that would be over in a matter of weeks, perhaps months. And it just seems, if anything, it just drags on, doesn't it?
It does, and ultimately, Germany will be able to build the infrastructure to protect them from the cutoff of gas. We estimate that by next winter, they should have built enough LPG importation facilities to cover it, but they are vulnerable this year. And I think the message to many countries is you need a diversified energy source. I mean, with the benefit of hindsight, which always helps, relying 70% for your country's energy on one source has been not a winning strategy, I'm afraid.
It took us 15 years, but I think we're learning that lesson ourselves. And if it makes you feel any better, I came here in an EV. The good folks at Land Rover lent it for me for a week. So thank you very much.
Thank you.
Thank you very much, Richard Carlisle. All right, ladies and gentlemen, folks, we're going to end off now with our keynote speaker. And as much as we can prepare and live in an ever-changing and ever-evolving world, that is, in fact, our reality, is it not? So our keynote speaker is really going to open our eyes to what life's third age could entail. Please, a round of applause for Dion Chang.
Thanks, Bongani. Something strange is happening to age and aging. If you think about it, a 75-year-old today looks like what somebody in the 1930s looked at 50 or so. It's not uncommon for more people to be turning 90. So I want to delve into, and I'll explain why I call this life's third age.
When you talk about life's third age, what is the impact going to be in terms of workforce and companies and the management thereof?
Yeah, so as I said, you're going to have companies that maybe have 4, sometimes 5 generations in there. It gets very complicated, and then you layer on top of that what all companies are struggling with is, do we do a hybrid way of coming back to work? What's the workforce? Is it 3 days, 2 days? What kind of doing that? So it's a very complicated revolution that we are going into. And what I say to a lot of the clients that we deal with is don't underestimate the lockdown life audit that we've had. It's really changed people's minds, and especially for people going into their life's third age, is like, well, actually, do I really want to sit at home and just kind of do nothing, or do I want to do something with our life? So you see this happening with revenge travel, everybody trying to travel, but they can't because everybody's being stuck in their luggage is lost. So I think life's third age is going to get people to either go back to work, become consultants, start their own businesses. It's going to be a very, very interesting period, but lots of uncharted waters as well.
So do we need to rethink even that number, 60 or 65, as the case may be? I mean, if people are living longer, how or why do we lock retirement at a specific age?
Great question, but I think it's part of a bigger construct. If you look at corporate culture, corporate way of working, all of those kind of things. It's a template from the 20th century. Even the whole thing, it's a very contentious issue, but I talk a lot about a 4-day work week. And I'm saying this is, again, a fundamental revolution of where we're going with work, what we want out of life, and what we don't. And that sort of cutoff age of 65 or 60 is just, it's a relic of the 20th century, basically. But yes, we have to rethink those things.
Adapt or die, as they say.
Yes.
Right, I'm going to ask you to stay seated, but I'm going to invite all of our presenters who, of course, so far have shared incredible insights, really thought-provoking ideas. But I'm most excited about our next session because we are going to sort of bring this entire conversation together and come together on stage. So please, may I ask Taj Mohammed Badruddin, Richard Carlisle, Linda Sherlock, and of course Dion Chang is with us, as well as Ayanda Siboni. Please come back on stage. Let's have a chat. Ayanda, let me start with you. There is a young 28-year-old somewhere who believes that, a bird in hand is worth two in the bush, as they say. Why not accumulate assets, but also live a little instead of having a focused retirement strategy? You'll think about it a little later on. Why is that not so wise?
Mongani, don't reveal my age in public now. Come on. Reason, compound interest. It's magical in growing your money, and you must just never underestimate it. Over and above that, saving a little bit is like exercise. At first it's painful, and you struggle with it, and then later you're so happy to reap the rewards. But you'll never, ever regret saving sufficiently, consistently, and early enough. And I can say this, Bongani, because I've got confidence. I was involved with some research, and I was privileged to see the results. And it was professionals who were at retirement, and there was a clear and consistent pattern. So those who had a healthy, trusting relationship with their advisors found themselves comfortable when it came to retirement. They had enough resources. And the reason why is because they were consistent in their savings, and they leveraged the expertise of the advisors as well as the people who are there to help you, fund managers who are there to help you manage your funds. But even when they had rainy days, because we all have rainy days, it doesn't matter how good you are, those were taken care of because they had planned for it. So, and then I look at those who had DIY as an approach. Those who had DIY fell victim to their own lack of skill, their emotions, like I mentioned earlier on, as well as the lack of discipline in saving. And they found themselves old and financially insecure. So the difference between these groups was not income ever. It was always the behavior. High income with poor savings discipline will never match consistency and financial discipline. And for me, what I've realized is that the road between 28 and 70 is shorter than you think. And in that road, many things can be materially changed by your behavior. So for me, I think those are the things that really matter.
It's the old hare and tortoise race, is it not?
Yes.
Richard, if you think about the current energy fossil fuel rally, what will that mean for environmental investing, ESG if you will?
So I think we think that the trend to clean energy is a sort of remorseless long-term trend, and global warming is well established and understood, and the consequences of that, I think, are being seen. In a way, when Russia invaded Ukraine, pushing up oil prices, that makes the existing technology more attractive, but it also gives existing energy companies enormous profits to redirect into green energy projects. I was just reading on my iPad that Shell's just announced record profits. UK gas company Centrica has paid a dividend for the first time in years. So, energy companies are currently super profitable, and what we do as investors is encourage them to think long term and invest in technologies that can make, many fossil fuels better. I mean, if you burn coal, there is flue gas desulfurization to make that a better for the environment, and you've got many carbon recapture technologies that can make existing fossil fuels just better for the environment, and we encourage that sort of research and development.
Because if anything, the pandemic has taught us to pivot and to be open to change and to embrace it quickly.
It has, I agree.
Linda, what if somebody ignored the advice we heard from Ayanda and they now find themselves approaching retirement or are at retirement and they've got debt?
It's a great question, Bongani. So there's two ways that you should go about it. The one is don't, as much as possible, don't go into retirement with debt. So have a look at those lump sums we talked about earlier and see what you can do to get that debt gone before you're physically living off your retirement income. Otherwise, you need to be planning to pay yourself to get rid of that debt. So when you're obviously budgeting for your income off your capital, you've got to work at getting that down. The right way is, even if you're 55 and you're carrying debt, or 57 or 59 and you're carrying debt, start getting rid of it now. So if I was advising you, not that you, but I would be saying to you, look, we need to start structuring this to get rid of debt so that when you do go into retirement, it's clean and you don't owe anybody anything except a good life.
Dion, I suppose that segues into different realities for different people, right? You've shown us what's happening in Switzerland and Beijing, but here in South Africa, when we talk about grandparents who for a long time now have had to look after grandchildren, we know the impact of the HIV/AIDS epidemic here and what that has meant for older folks. What does that picture look like here?
Yeah, I mean, that's quite worrying because, I mean, Linda talked about sandwich generation as well, and you know, we all understand in South Africa about black tax as well, and it has a really, really profound effect on it, because if you think about the burden that has been put on the seniors in South Africa, and especially that sort of Gen X specifically, kind of being decimated by the AIDS pandemic in the 80s and the 90s, then we've just got that kind of missing generation there. And you know, I think a lot of our senior citizens in South Africa do not have the luxury of being able to plan for this retirement, and then they're going to rely on their kids again, and then we're going to spiral into a very long conversation about skills, and we're seeing, you know, people that have gone through tertiary education, they don't have the jobs that they have and the unemployment, so there's just going to be this really, really bad bottleneck that we're fast approaching, and if life expectancy is going to do that, and you know, as we said, the longer you live, the more the medical burden at an older age is going to be there, so we actually have to, or public services and everything, have to gear up for that reality.
Grandparents looking after grandchildren, we've got the sandwich generation, all of that impacts on people's ability to put money away for retirement. Taj, let me ask you this question. Which is more important, asset allocation or manager selection?
Well, thanks, Bongani. I think both are crucial to really providing long-term investment returns. You know, asset allocation can really be broken down into two key components, the strategic and the tactical. And while the strategic looks at the longer term, the tactical looks to take advantage of that short-term market events to generate additional returns. Where we, however, believe that we can have an edge is really on the manager selection component, and that's a rigorous process, you know, coupled with a well-experienced investment team that allows us to have that consistency and that predictability for long-term investment returns.
Linda, are you seeing people getting excited about accessing their retirement savings earlier?
So I think that we need to, you know, it's not all unicorns, butterflies, and candy floss. So life is real, and we need to understand that we live in this fluid world where a situation arises that you didn't plan for, and access to a retirement fund is necessary. And I think the Treasury have responded very well to that challenge by introducing this two-pot system. And what they've done is they've said, pot one will give you access to up to a third, but you can only do it once a year. Pot two, however, which is 2/3, you cannot touch until you retire. So they're finding a solution for life, because it happens. And we need to move away from the academic of, you know, you don't touch and you save your 15% to the realities. And I think that that's a great adaptation that we're going to be seeing, and PPS supports it.
Richard, South Africans tend to be quite pessimistic, perhaps more than we should. I mean, Taj made the point that over the long term, we've actually had better results than many people would think. As an outsider, what's your perspective of South Africa's macro outlook?
So I agree, first of all. I've thoroughly enjoyed my week in South Africa, but it always slightly surprises me that, you know, people are quite cautious on domestic prospects. You know, our sense is there is enormous opportunity here. I mean, you have, you know, in Africa more broadly, and South Africa in particular, you have great resources, you have great workforce. It's also, I think, an economy that would benefit significantly from lower unemployment. We were discussing this morning that many of South Africa's problems seem to stem from unemployment. Getting unemployment down is good for any economy, but it strikes us that for South Africa in particular, it would have a great impact. And obviously your struggle with load load shedding. Solving that would be a nice positive as well, but that should be achievable. Take a long-term perspective, do the investment, and you can do that. And I just point out as well that, South Africa starts with lower government debt to GDP than my country, than the US, than Japan, than Italy, than Spain. That's not a bad starting place, actually, if you want to do infrastructure spending. So go South Africa.
Dion, unemployment is an issue. You talked about Africa being a young continent, right? As opposed to people being paid to procreate. So what does that mean if you've got all these young people, but who are unemployed and, more worryingly, in some cases, don't have the skills?
All right, so then I go back to, there's a World Economic Forum initiative that they're doing. They're trying to upskill and give millions of young people around the world skills and employment by mid-century, or before that, even 2030, 2040 or so. And one of the things they propose are micro-credentials. And I'm glad, Linda, you said we must move away from the academic approach to the savings, and in the same breath, it's about the skills as well. I look at a lot of research that's being done, and you look at the future of businesses and where businesses are going, and we've reached a stage where we've over-credentialized requirements for employment. So you're getting the whole thing about, especially in South Africa, you have what in most common, the first child to go through tertiary education, and the parents save up and they sacrifice everything to do that, because that piece of paper is going to open the doors of opportunity. And there was a TV program just this week where it said the 60% of the people that are applying for the 380 Rand grant all have tertiary qualifications. I mean, that's frightening. That is really, really frightening. So micro-credentials for me is the answer, and that's what the World Economic Forum is proposing. So in a country like South Africa, you can upskill people a lot faster. You don't do a 4-year academic degree. You have short courses, and what they say is you collect a digital backpack. And if I then sort of layer on sort of our research on where the future of work is and where the future of businesses are doing, you're starting to see that you need multiple hybrid skills that change all the time. And even for everybody else in the room and watching at home and this is going to be a bit of an ouch to say at a retirement conference, but your skills in a digital era become obsolete at the age of 40. You have to reskill. So short courses, not only for young people, but short courses for skilled people is essential. And that is the one thing for me that we should do that. But that also requires businesses to reframe recruitment and entry-level qualifications to come into a business and understand that. But just on that, Japan's space program does not require you to have a degree. So, I mean, this is training astronauts for a space program. They say you don't actually have to have a degree to be able to do that. And of course, EY dropped the HR bombshell in 2015, and they said you don't actually have to have a academic qualification to come and see us, but we'd still like to speak to you as well, because there's a different metric. So that's the way the world is going, for me.
Gosh. Taj, how do investment managers choose an asset allocation?
So asset allocation is a very important part of creating and balancing an investment portfolio. It's one of those main factors that leads to the overall return of the fund. And as such, developing that ideal asset allocation strategy is an involved and a rigorous process, whereby investment professionals, they analyze the historic movements of various asset classes, and then what they do is they put a forward-looking overlay or assumptions based on that current view. There isn't really a one-size-fits-all when it comes to asset allocation, as each individual will have their own set of requirements. However, we offer a wide range of funds that span the entire spectrum of asset allocation at PPS.
Ayanda, I want to be invited back next year, so let me ask you this question. Why PPS? You're a marketer. The floor is yours.
Okay. 1, an 80-year track record of consistently delivering to graduate professionals in a committed way cannot be wrong, right? Hundreds of thousands of graduate professionals are with PPS because they choose us because we are the best. Number 2, over 31 billion paid back as allocated as a cumulative in the profit share account. And we have over 7,000 profit share millionaires. So a profit share millionaire is someone who has received profit share more than R1 million. That's real money that they get net of tax, which is just incredible. So that is what makes PPS, absolutely special. And also, I'll leave it there.
Okay. Well, that's about all the time we have for. So thank you very much to our panelists, folks watching online, and everyone here in the room. That concludes the PPS Retirement Summit for today. So thank you to all our speakers who participated and who joined in the conversation today. And of course, thank you to all our guests for attending both here and online. Now, if you missed any segment or presentation today, please tune into Business Day TV in August to catch the highlights. You're also welcome to visit www.pps.co.za/Retirement Summit, where you can access content related to today and last year's Retirement Summit for that matter. The PPS Retirement Summit plan for the retirement you deserve. Thank you.